of documents will be there, what kind of conditions to fulfill. And then lastly, they will have general clauses on confidentiality, exclusivity, and things like that. All right. So we this is how it would look like. Now the first set of transaction documents, the first set of details will have details of the business, details of the founders, what is the valuation of the company, are they investing in CCPS of the company or CCD of the company, right? So the most important bit for the first part of your transaction details or your term sheet is to understand what is the instrument. So you would have heard of this term called preference shares or equity shares or compulsorily convertible debentures, convertible notes, safe notes, etc. So what do you think the difference is? If anybody in the session can explain what they think the difference is between an equity share or a preference share or a debenture.
So equity, to the way I understand, is mainly based on the valuation of the startup or the company at the current juncture. An investor buys stakes and invest in the company.
That's
But
right.
CCD or debt, there are debt-based things where you have to only pay back by with interest. But most of them go with CCD or CCP. CCD is more to ensure that, okay, we give you this fund, but eventually as you scale up, when you raise funds, the valuation, they will have a preferential valuation, which at the time they put the money in that time, whatever the valuation was, they would own much of as we eventually scale up. I hope that is what my understanding is.
Yes, sir. That is absolutely correct understanding. So for any company to raise funds, there are three ways to do it, right? So one is through equity, that is through ownership. Second is, as sir said, through debt, right? You take loans or you take debentures. And third is by the sales and revenue of the company itself, where if you're selling products, if you're selling services, these three are the only ways in which a company can make money. All right. Now, because investors are not customers, they can either, and they are not part of the people who, even though they might be customers in terms of them buying products and services of your company, they would want to have an ownership stake in your company, either directly or indirectly, right? So if it's a direct, if they want to acquire ownership directly, then they will invest in the equity shares of the company. Now, equity shares are of two types. One is plain equity shares, which all of you in this room will be holding. When you subscribe to the company, each of you might have about 5,000 or 10,000 shares, depending on how 5,000 or 9,000 or 9,990 or whatever percentage you have agreed on the starting of the company. And any other investor who comes, they would ask for something called a preference share. Now, simply put, a preference share has preference over equity shares under the law. What does this mean? The moment I am holding a preference share, it means that I have a preference over equity shareholders in two things. One is dividend, right? So every preference share has a dividend percentage that they're supposed to get, right? Even if they don't get over a period of time, they get accumulated over time. And under the law, they're entitled to get dividend. Two is, let's say, assuming the company shuts down for whatever reason, you have to liquidate the company, sell all the assets, close down the business, and everything else. Before the equity shareholders, that is, before all of you guys get paid, they will be able to take their stake of the company. Broadly, these two are the reasons why investors preference shares, why investors ask for preference shares over equity shares. So this is on the equity side of it, right? Then there is the debt side. Debt side is, you can either go to a normal bank and take a normal bank loan, pay the interest and take the money back, or you will have something called a convertible debenture. What they'll say is that, look, here I am giving you a loan of 10 lakhs, 20 lakhs, whatever. I don't know if the company is going to succeed or fail. But if the company fails, because I am a loan, because I'm a debt holder, I will get back my money before anybody else. You're supposed to pay me interest and get it back. I'm so sorry. Just give me 1 second. I'm so sorry. Yeah, I'm extremely sorry about that. Now, in case of a debt, because a typical bank loan, you take the interest and you pay it back, or a convertible debenture, what they say is that, look, I'll pay you X amount of money. If you can pay me back in X time, it's good. Or if I think it is successful, right? I think it's going to be good. I will convert my debt into shares of the company. We'll talk about conversion mechanics and how that functions a little later, but this is the broad principle that you can either raise equity or you can either raise debt. We had seen some questions that what are safe notes, can we do safe notes, etc. A safe note, in the context of Indian law, a safe note is not allowed, right? Under the Indian legal system, any form of investment in a company has to uh, be through something called a security. A security is you either have to get shares or debentures. Whereas in a safe note, it is effectively a promissory note, right? And a safe note, a simple agreement for future equity, where it says that I'm giving you money today, but the company promises to give me shares later on. Under Indian law, that is not allowed, right? Uh, Under Indian law, companies cannot accept money from general public or accept money from anybody without giving them anything in return. If that happens, it's called a deposit, and there are certain set of there is a prohibition on seeking a deposit, and there are certain set of regulations that apply if you are taking a deposit for whatever reason. But the question then becomes, is there a hybrid instrument? Is there something that is not exactly equity, not exactly debt also? The solution for that is there is something called a convertible note. A convertible note, yeah, how do we get friends and family investment or loans? I will just answer that question right after I explain convertible note. So if you are using a an instrument called convertible note, what I explained, right? It says I am giving you money now and you give me shares later. The same concept, but recognized by law. The convertible note agreement, so whether it's 5 pages, 10 pages, 20 pages, that itself becomes the instrument. You will have certain rights. You will say that if the company raises money in the future, I will get these money shares. If they don't raise money in the future, then this is, I need to get my money back. There will be all sets of terms and conditions. But every startup or anybody and everybody cannot raise a convertible note. You have to be a recognized startup called, and this recognition is given to you by the government of India. So there is a ministry called the DPIIT, Department of Promotion of Industry and Internal Trade. You have to apply for a Startup India recognition certificate, and only after you apply, you get the recognition. And one is two, you need to be a startup. Two is that the minimum ticket size, that's the minimum amount of investment, has to be 25 lakhs. If it's under 25 lakhs, you cannot issue a convertible note. Now, to come to the question of how do we get friends and family and investment or loans, for the purpose of the company, friends and family, they are all just the same people, right? They are an external investor for the company. So the procedure to follow is how you would give shares to any other person, right? There is a procedure called the private placement process. Simply put, that you need to give them something called an offer letter, right? I will explain that into detail, but just to answer this question on the chat, there is an offer letter that you issue, then you hold a shareholders meeting and you hold a board meeting, and then you allot the shares to them. At the time of allotment, you give them share certificates. This is very simply put the process, but in the next section of this presentation, I'll walk you through what the process is. Right now I'm just at the
Yeah, Sandesh, I thought I'll just step in for a second. When the person here is asking about loans from family and friends, what Sandesh mentioned a few seconds ago about the deposit regulations that will be attracted whenever the company takes money from individuals. Okay? Loan from other corporates is a more relaxed structure. Intercorporate loans are permitted. The government wants to be very careful when companies accept money from individuals, which is where the deposit rules, restrictions, and prohibitions come into play. So there are workarounds for this, legitimate workarounds. One common way to do this is if you as the promoter, right, you want to infuse cash into the company, then one method is for you to take the loan and then put in the cash, or you have the person who is intending to give the money as a director or a shareholder and then take the money into the company. So there are workarounds, but overarching principle you need to keep in mind: whenever you take money into the company or you want to take money into the company from individuals, you need to hit the pause button and check with your professional advisors for guidance. Right?
Thank you, sir. Yes. Done.
Now, the second important thing in the term, first is the instrument. The second important thing in the term sheet you need to look at is what are the set of rights that they're asking for in terms of economics and control. So broadly, a term sheet will have two sets of rights. One is rights that affect the money part of the investment. How is the money going to be accepted into the company? How is it going to be protected? How is it going to be utilized? And how are they going to get a return? That's the first set of rights that they talk about. The second set of rights is how am I going to control the company? What are the rights I have on the board of directors? What are the rights I have against the promoters? So against the founders selling the shares and running away, or whether they're taking decisions that affect the investment of the company. So let's say today you promise the investor that you are into the business of telehealth or telemedicine, etc., and tomorrow suddenly you pivot into an e-commerce model selling pharmaceuticals or selling doctor appointments, etc. The investor would want to know whether A, what is the business that you're doing, and two is whether my initial investment thesis is being followed or not. This is broadly the set of rights that they ask for, and these rights are in the form of restrictions on transfer of shares or issue of new shares. Now, I did not bring this up in the first part, but the point is, any time a company has to raise money, right? Company issues fresh shares from the company. It is not that you are giving away your existing shares to an investor and you're taking that money from the investor into your pocket. Rather, it is the company that is issuing fresh shares to an investor, and the investor is putting money into the bank account of the company. Which is why I said in the starting of the presentation that a company is a separate, distinct entity and a separate, distinct person altogether, right? Then how that company is going to run, right? Whoever is holding those shares, whether what are the restrictions on them selling those shares or what they ask for in the term sheet. We'll get to that in the we'll get to each of those restrictions in the next section. The last set is your documentation. So they'll say that after you enter into this term sheet, after we sign this term sheet, you are supposed to enter into a document called a shareholders agreement or a share subscription agreement, which usually about 30 to 80 pages long, depending on what each investor uses. And they will also set out broad conditions to fulfill before they get the money into the company. So it's not like on the day you sign the agreement, the money hits your account. No, you sign the agreement, then there are certain conditions to fulfill. Some of them are as per the law. So once you sign the agreement, then the legal provisions kick in, where you have to give them an offer letter, you have to hold a board meeting, you have to hold a shareholders meeting, and then you need to approve. Both the board and the shareholders have to approve, and only then the shares get allotted. So these conditions are usually documented in the term sheet and even in the main documents, right? And the last set of terms, this is important for an investor also, is you will have confidentiality and no shop. You'll see something called a no shop clause or exclusivity. What they'll say is that now that you've entered into this arrangement with us, for the next 60 days or for the next 90 days, you are not supposed to go and talk to any other investors for raising funds, or you can't use this term sheet as a base and go around shopping saying, oh, X investor is giving me 100 crores. Are you willing to give me 150? So, and so on, and use one term sheet on top of the other to get a better deal. There is a restriction on that. Practically, what happens is that they make the conversation between an investor and the company and the promoter is very upfront. They will tell the investor that, look, we are talking to other investors also, and they're very upfront about it. that we are talking to other investors also, and this is what the valuation and these are the terms that they're offering. Can you come on the same page? So the promoter or the founders of the company try to bring all investors that they're negotiating with on the same page, but the intention is that the investor you cannot use this term sheet behind the investor's back to go and find a better deal. Two is expenses. So the investor would incur some expenses on doing a basic due diligence on your company. That is, they want to check whether you've done your filings properly. They want to check through their CA or through their lawyers whether your books of accounts are kept properly, whether your statutory registers are kept properly, whether you've been holding your meetings regularly, whether there are any penalties by any regulator. There are about 6 to 7 things that they check, and you are asked to send those documents to them. And it all incurs a cost. They do it through professional advisors, and the documentation also involves some cost. And even the process of issuing shares also involves some cost. But the biggest expense of it would be stamp duty, where on the value of the share you have to pay a percentage of it depending on which state you are in. So these kind of expenses, you decide upfront whether the company will bear everything or the investor will bear half, company will bear half. What are those things? Those basic housekeeping items are taken care of in the term sheet. So I will stop presenting the term sheet now and move on to the main presentation, which explains each of these concepts in detail. Before I do that, if you have any questions, I'll take them up. I see one question with
Yeah, Sandesh.
Yes, sir.
Yeah, so I will keep track of the questions so that you can probably go through your presentation. As and when I think that a question is relevant for the content that you are presenting, maybe I will request you to pause and we can discuss the question. Okay.
Sure, sir. Sure, sir.
So, interesting questions here. There are 3 questions, right? Convertible debenture, OCD, CCD, is there any minimum money condition? No, there is no minimum money condition for convertible debentures. The second question is very interesting. At least I personally can't claim to have an answer to it at this moment, but we will certainly look into this, and offline we will respond to this group with any questions we are not able to answer right away on the presentation. The question itself is very interesting because once your startup recognition kind of expires on its own after 10 years, your question is, can you continue issuing convertible notes, right? That's a very interesting question. We'll look into it and come back to you. Third question, yes, you can issue convertible notes to an individual provided that the other conditions are met, which is 25 lakhs in one tranche, single tranche 25 lakhs. That person needs to bring in. It can't be split between more than, split across several individuals. Yeah, please continue, Sandesh.
Yes, sir. I'm trying to open the presentation. Just give me 1 second.
So in the meantime, on the term sheet itself, one big benefit of having a very good term sheet is that both parties, the promoters on the one hand and the investor on the other, will not go back to the drawing board and revisit fundamentals, right? In our work, we come across term sheets that are not so well drafted. And what that means is that there's a lot of wastage of time when both teams, legal teams, chartered accountants, everybody else, all the professionals get together and they want to kickstart the actual transaction process. People waste a lot of time because they were not clear on what they wanted from each other at the time of the term sheet. So it is very important to lay down all the cards on the table, right? And set out the expectations very clearly in the term sheet. Otherwise, things will get unnecessarily derailed, and very often we see that the trust quotient also goes away. If fundamentals are revisited, then some kind of blame game starts, and the trust disappears. So we always recommend that both parties, investors and the company, execute a well-drafted term sheet. This is not an issue when it comes to fundraise from an institutional investor. When you're raising funds from family and friends, right? It can take a very semi-casual kind of turn. we usually suggest please don't let that happen and have a proper term sheet to begin with. Okay. Yeah. Sandesh, please.
Can you see the screen? Are you able to see my screen? I won't be able to see you because I'm sharing my screen.
Yeah, we can see it.
Okay. So we covered the term sheet. That is, there will be a few more. One of the things that I didn't mention earlier is that except for a few terms like confidentiality, exclusivity, governing law, most of them will be non-binding. But the expectation is that what is there in the term sheet ends up getting reflected in the larger documents, in the larger legal documents with either the share subscription agreement or the share purchase agreement, etc. Now, one of the things that they also do is they set a timeline for the execution of the documents, right? So they say 60 days or 90 days or 120 days. And in case the documents are not executed within that period of time, right, usually the term sheet then gets extended. Both the parties have to come back to the table and say that we've been spending a lot of time on negotiating the documents, so why don't we extend the timeline under the term sheet. So the next step is the due diligence process, right? So I briefly touched upon what happens in a due diligence. So typically, once you sign the term sheet and both parties have agreed to get into this transaction, uh, somebody like us will be engaged by an investor, and they'll ask us to do a due diligence on you guys, on the company and on the, and if it's a high profile promoter, then I also ask us to check whether the promoter is a director in any other companies and things like that. But otherwise there will be a checklist of close to 80 to 100 80 to 100 items, your board minutes, your financial statements, your charter documents, that is something called the memorandum of association, articles of association, which are the basic governing documents for the company. They'll also ask you to give copies of all of your contracts that you've entered into with your employees, with your consultants, with your customers, with any other third parties, that with your service providers, with anyone else that has a bearing on the company. And your filings, whether you've done your filings on time under the Companies Act, whether you've made your filings under the relevant labor laws, whether you have the proper registrations depending on which state you are, whether you have the necessary licenses to undertake your business. So that list will have about 80 to 100 items. More often than not, at stages of companies where they are just incorporated or about 2 to 3 years old, uh, about 30 to 40% of the requisition list usually will not be applicable to them at all. So one good exercise that you can do is you can upfront communicate to the investor or the investor's legal team saying that all of these are not applicable to us at all, and give them the set of documents that you have. How is this done? So it's very straightforward. You put everything onto a OneDrive folder or a Google Drive folder, and one of the operational things that we have seen helps is that you give the investor or the investor's legal team the documents in the order that they have asked, right? So that whoever is looking at the room don't come back to you and say, oh, this is not there, that is not there, and then you go end up spending time saying, oh, this is in folder number 8, this is folder number 11. Instead, what helps is whatever serial numbers that the company or the investor or the investor's legal team would have given, just upload the documents with the same serial number in that order, and things end up going really smoothly. Now, one of the important things is that due diligence is like the first impression on your company. Yes, as founders, you would have met the investors and you would have had meetings and you would have signed the term sheet. But at an early stage, typically you don't end up meeting the investors more than twice or thrice, at least at an institutional level or even at an angel investor platform level. It's usually once or twice that you meet the company and you form your impression, and you make your case for an investment, or it doesn't happen. But after they decide to invest, or after they decide to look into the company, if the documents are well maintained, if everything is if all the questions by the investor and their legal team or their finance team is answered on time, and if everything is handled very smoothly and professionally, it creates a good impression on the investor that this is a well governed company. The investors advisors also get enough comfort to tell the investor that you can go ahead with this investment, or this is a good investment to make. So that creates a really good impression on the investor and sets the roadmap for what could be a very long relationship between the investor and the founder. Because the outcome of your due diligence ends up being reflected in the transaction document. If there are several non-compliances, if filings are not made on time, if there are a lot of penalties that are being highlighted, all of those then become conditions to fulfill, that they'll say go and pay the penalties, go and fix your filings, go and regularize certain delays. That will only delay your investment from the investor, because until you fulfill these conditions, the investor would not want to put the money into the company. Because the fear is that once the investor puts the money, the company and the founders are now going to use the investors money in regularizing all this, in paying the fines and paying the penalties, when that is not the case for why the investor would want to invest in the company. So maintaining proper paperwork, keeping at least allocating enough mental bandwidth to just ensure that your general filings are being taken care of regularly, or just having a good CA or a company secretary who can help you with these on a regular basis, goes a long way in creating that good first impression. Right. So this is something that you will see, that we will ask for documents under the Companies Act, under labor laws. If you have received money from foreign investors, then under foreign exchange laws, and contracts with all kinds of third parties. And if you have raised money from a certain set of investors already, then that becomes a very important document, that the new investor would want to know what are the sets of rights that the existing investors have. I'm going to skip this part because of lack of time. So, before I move into the transaction documents, any questions on diligence and term sheet, or both?
Hi, Sandesh, am I audible?
Yes, you are.
Yeah, so I had one question on the term sheet. Under that, you mentioned that there's has to be like 60 days under exclusivity clause,
Right.
wherein we shouldn't go and sign another term sheet or raise funds on the term sheet which is already signed.
That's right.
But for a higher valuation and for closing the round, we have to go to other investors. So is it like is there any binding? Is this 60 days binding, or they can we negotiate on this with the current investors?
Sir, can I take that?
Yeah, please.
So it's a matter of being upfront with the investor. If you are looking to let's say you're looking to raise 1 crore at a 10 crore valuation, right? But your current investor is willing to pay you only 50 lakhs or 30 lakhs. But you're going to tell your investor that, look, I really need 1 crore. So I'm going to go and ask other investors whether they're willing to pitch in. So as you said, for closing the round, for you to close the round, you want to achieve the amount of money that you need to raise. So if you're telling your investor upfront that I am having conversations with other investors, then it should be fine, and it's not something that will be a problem.
Got it. Thank you.
So there is now that we paused for the couple of questions, there's one more question from Rajkumar. We are an
Yes.
energy startup. Can we get money from individuals through consultation given before selling our service? Can you just explain this a little bit, Mr. Rajkumar?
Sure, sir. Very good afternoon to all. Sir, in the energy terms, what we do is that we will be providing a consultation before even starting a project. We are into hydro energy, okay?
Okay.
Whenever we do an hydro project, we do consultation first, second is validation, and then only we actually go for the contract.
Okay.
Okay, just to all these part involves human resources. So is it okay to take consultation and validation part even before starting a commercial contract with the client? can we do? Buy some. Sell a consultation and charge it for that.
We understood the question, but unless I'm mistaken, I don't think it is really directly related to the topic of investment that we are discussing, right? But we are happy to take this at the end or even offline. Okay, because
Okay, sir.
to me this is a question that is very important, but more relevant to a general commercial discussion of how contracts are executed and the commercial terms that the parties agree upon. Okay, so we'll park this and come back to this a little later.
Okay, sir. Thank you.
Thank you. How they identify turnover like docs, or also they ask for all previous invoices. See, it depends on where you are as a company, honestly, right? How young or how mature you are on your business journey. From a financial diligence perspective, there will be a thorough examination of your books by the finance due diligence team. And as part of that, if they want to verify every piece of paper that you have, then that is how it is. So which again brings us to the point that Sandesh was making a few minutes earlier, that the more professional your bookkeeping and record keeping are, the better the impression that you convey, and the easier the due diligence exercise also is completed to everybody's satisfaction. But specifically to your question, yes, they can ask. How do they identify turnover, profit? It's a mixture of interviewing you as the promoter personally, and corroborating that with whatever documents you're supposed to maintain under the law, right? Your IT returns, your books, your audited statements, plus in-person discussion with you. This is how they arrive at some kind of a picture that they want to examine. On the finance side, I'm talking about. Legal due diligence is different. Okay. I think Mr. Tarun Adarsh has raised his hand. Yes, sir.
Yes, sir. Sir, I just need more clarification in a statement from the fact that if we are raising some amount, like maybe a very little amount, 4 or 5 lakhs, from a friend, like, and they are willing to give us without having any requirement of equity or something. But that's what we believe in future if the company has any valuation, because early stage it does not have any value other than the face value of the 10 rupees, whatever the per share is there. But at early stage, if they have invested some amount, so can we take it in the form of a loan, like from we can take it from our end as a director, and then we can deposit in the company as a loan to the company? Or because CCT is not possible, 25 lakhs, that transaction threshold is not there. Other thing is that they don't want equities and something. And as just Sandesh has already mentioned that SAFE is not legally valid in India. So technically the terms happened was similar to SAFE, but now since I came to know that this is not allowed, like what is the possibility? How this thing can be fixed in that way?
Yes, Sandesh, you can take that. Otherwise, I will answer.
You can answer, sir. That's okay.
No, so this is as I was discussing a few minutes ago, Tarun, you will have to take it because you are taking money from individuals. Okay, you will have to take it and then infuse it into the company. So on the books of the company, it will appear like a loan from the promoter or the director. It can't be directly a loan from an individual who is outside the company, who is neither of these two, neither a member shareholder nor a director.
Okay, and in case if we have to return them, like they have invested, so in some what we say belief that in future some returns they can get. So suppose after some time when I get something and I give that money to that particular person, then do you think that has to be given through the company, or again through the route of a promoter?
Through the promoter only, because it will have to go out the same way it came in.
Okay, noted.
Right, on the books it is now a transaction between the promoter and the company. This third party is nowhere in the picture on the books of the company.
Okay.
Right, so suddenly it can't be a payment to this third party without any corresponding entry on the credit side.
Noted. Oh, thank you, sir.
Yeah, at this point, I would also like to recommend to everybody here that you need to build a good relationship with a chartered accountant, with a competent chartered accountant. In fact, you will need the services of a good professional CA earlier than you need a lawyer, right? Because your chartered accountancy related activities of the company start from day one. So please invest some time and also little bit of money, budget it, and get into a working relationship with a chartered accountant whom you trust, whom you can pick up the phone and talk to. Okay, it is important for you to develop that at the early stage in order to avoid any fines, penalties, other wastage of time and money down the line, right? So something like what Tarun was asking, a good CA will advise you on how to get this done and do the necessary paperwork also for you. Yes, sir. Sandesh, please continue.
So just to add on that one point, so one of the routes is, Tarun, you take the money yourself and loan it to the company and give it back to them later. The other option is you can also give them a debenture, right? So if they don't want shares in the company, but they're expecting a return, right? The question then you have to ask is, how are they expecting a return? Because if you let's say if you want a return, you buy shares of Infosys or Wipro on the stock market, and when you invest money, you get shares of Infosys or Wipro, and when the share price goes up, you get a return, right?
Yes.
But if they don't want shares in the company, then the question to ask them is, what is it that they are expecting in return? Because when they talk, a lot of people, they say it's an investment, but actually what they want is they're giving you a loan. They say that, look, I'm giving you a loan, please give me at least 10% back, right? So you first need to understand what is it that they're expecting. Are they willing to take the risk with the company, or do they have an assured return in mind? If they want an assured sum of money back to them, then you can give them a debenture. Simple debenture, because you cannot have money, or as sir said, you can take the money yourself, put it in the company and give it back to them with interest. If they want to take the risk in the company and see where it goes, then shares is the best route to give.
Okay. Thank you.
So last question before Sandesh moves on. Employee who is not an executive employee, can they invest? Yes, they can, but experience that can lead to HR problems. You will be right. You will be entering into HR problems of various types, which we can probably explain later. But legally, there is no bar. Yes, sir. Sandesh.
Yes, sir. I'm just going back to the window. So if one of you can somebody tell me if you can see my screen?
Yeah, I can see it.
Okay, great. So after the term sheet is over, and while ideally after the term sheet is over, after due diligence is over, you sign something called a transaction document. But practically what happens is, while the due diligence is going on, the negotiation on the transaction documents begins, right? There's two sets of documents, or sometimes both sets of documents is combined into the same document, which is called the share subscription and shareholders agreement, or it's broken up into a share subscription agreement and a shareholders agreement. We see a lot of creative names sometimes, that investment agreement or investment cum rights agreement or subscription and rights agreement. It can be anything, but the two sets of documents governs two different sets of items. The share subscription part is a procedural document. It lays down the process in which the company is going to hold the board meetings, allot the shares, commence the and after the shares are given, then what are the actions they need to take? Before the shares are given, what are the actions we need to take? So in the term sheet, you would have seen a term called conditions precedent, right? Conditions precedent to closing. So this is what I said, that on the day of signing, you're not going to get the money, right? So the first step is signing. Second step is closing. So before signing, there are some actions to take. For example, you have to pass a board resolution authorizing one of you to sign the document. Then you will, once you sign, there are certain conditions to fulfill before you close. So you can imagine closing as the day on which both parties shake hands, the share certificates are being issued, the money is coming in, all the kind you see in movies and TV shows. That is the effective day of closing, not on signing, right? So we'll go into each of these concepts, but an SSA or a share subscription agreement is the procedural aspect. The shareholders agreement is the control and the rights aspect of things. So after this, there's also something called an executive employment contract, which is, as I stated earlier, all of you as founders of the company are also employees of the company, are also shareholders of the company and directors of the company. In your shareholders agreement, you as a director and you as a shareholder is covered, but you as an employee gets covered as a separate employment contract between you and the company, which most investors ask you to sign once they infuse capital, once they infuse money into the company. So let's look at what are the kind of items that go into a share subscription agreement. The first set of clauses will be what is the amount that they're giving, what is the instrument that they're subscribing to, and what is the procedure for issuing that investment. So we covered what kinds of instruments are there. We covered investment amount can be anything. So that is something that you and the investor negotiate. And the closing is what the document will govern. What the document will lay out is, one is you will do a direct wire transfer into the company. The company will pass a board resolution to allot the shares and give the share certificates. Sometimes if the investor is a big investor and they're investing a lot of money, they would appoint somebody on their behalf to be a director, or they themselves will become a director in the company. There are people in this cohort where they have external directors, and I'm guessing some of them are directors who have invested in the company, right? Then the fourth part is adoption of the articles. Now, this is a slightly technical point. Even if this is not clear, we'll take up questions on this separately later on. But when on the day of incorporating the agreement, on the day of incorporating the company, you would have seen a document called Articles of Association, right? The Articles of Association is the document that governs everything in the company. Like how for the country we have the Constitution of India, for your company, Articles of Association is the main thing, right? Anything that the article says or anything that the article authorizes, then the company can do it. So between individuals, there is a contract, but between the company and its shareholders, it is the Articles of Association. So what happens is, after you enter into these transaction documents, right, whatever clauses are there in your transaction documents, your let's say investor nominee director is there, then investors will have something called preemptive rights. That is whatever restrictions they have on you guys, on you not leaving the company, on you not selling your shares for 4 years, 5 years. All of those clauses get copied and pasted into your Articles of Association, which then makes it binding on the company also. It is not just an agreement between you and the investor, but the company also has to ensure that these things are followed. It goes back to my earlier concept that the company is treated as a separate individual. So the company also has to, as and when the company grows, when there are more people in management, the management also has to ensure that all the clauses in transaction documents entered into by the company are all adhered to. Then the next set of documents are your CP and CS, your conditions precedent and your conditions subsequent. One set of CPs are your compliance related items. So that is, you have to hold your shareholder meetings, you have to hold your board meetings, you have to issue an offer letter, you have to pay stamp duty on share certificates. Yeah, those are closing items. Now, when they do your due diligence, sometimes they'll say that, look, the contracts you've entered into with these vendors are not good. Please amend them. Or they'll say that unless the company enters into an employment agreement with the founder, we will not invest, right? Or sometimes they'll say that, look, there are certain penalties to be paid, there are certain fines to be paid, please go and pay them. or there can be even commercial and financial targets also. Sometimes if you're awaiting if you're a SaaS company, if you're a B2B SaaS company and you're awaiting a very big vendor contract, if you're awaiting a very big customer to be onboarded, they'll say that we'll sign the agreement, but after you onboard the customer, we will invest in the company. Or there might be certain contracts that you want to terminate for whatever reasons. Maybe there is a conflict of interest. Maybe as per your business plan, you should not have these contracts anymore. They will ask you to terminate those contracts. So it can be anything as agreed between you and your investor on what these conditions should be, right? Now, sometimes after, it might be very difficult for you to fulfill all of these conditions right before they give the money. So if they're not really critical, if they are important but not urgent or necessary, then they are moved to something called a condition subsequent to closing. That is, even after you get the money, you can still fulfill those conditions. So that all of these also have timelines. So they will say after 60 days of receiving the money, these have to be fulfilled. After 120 days of receiving the money, these have to be fulfilled. Those kind of things. Then this is an important part, right? So when you are talking at the term sheet stage, you are telling your investor that, look, my company is good, my company has traction, I have X number of customers, I have Y product that is really good, we've achieved product market fit, our revenue projections are XYZ, and we are in a great position to make money, right? But that's a commercial discussion you're having in a boardroom or you're having in a Zoom call like this. But if you translate those statements, if you translate the pitch into legal language, effectively what you're trying to tell them is that I am making certain statements to induce you into signing this contract. Effectively meaning, if you sign this contract, then I get the money, right? What these statements or what these representations and warranties do is that they bridge the information asymmetry. You know more about the company than the investor, right? You know more about the way your company runs. You know more about what kind of problems you have in the company or what kind of potential problems might arise in the company, but the investor does not know that, right? So what you're going to tell the investor is it's usually divided into 8 to 10 sections. That is, you're going to say that, look, I am incorporated correctly, I have paid all my taxes on time, I have made all my filings on time, I don't have cases against me, all my employees have valid and binding contracts with me, my IP is safe, my IP is protected, then I don't have any pending litigations against me in my personal capacity or against the founder or against the company. I don't have anything prohibiting me in doing the business as I'm doing currently. All the things that you take for granted, all the basic assumptions that you make or you want the investor to make before investing in the company are all translated into the section called the representations and warranties. These are effectively promises you are making to the investor, or these are effectively statements that you tell the investor that all these statements I'm telling you are true. Please believe me and then put the money into my company. These are what you call representations and warranties. There are typically two sets of representations and warranties. One is your compliance and fundamental warranties. That is, you have the authority, you have the capacity, the title to shares that is given to them are all correct, and there are no problems. Then you have your operational related warranties. That is, my business is healthy, my financial condition is safe, I don't have anything that will drive me into bankruptcy or liquidation, if all the information that I have given you is true and correct, those kind of things. But sometimes I think especially the reality of India is that no company can be 100% compliant, or no business will not have any problems, right? There will always be problems, there will always be non-compliances, there will always be issues that come up, right? So then you be upfront with the investor. You say that I am saying all of these things, except there is one employee who might cause an issue, or there is one notice that we have received again by this X person, or there is one recovery due that we have to institute against a vendor. Those are exceptions. So those get caught in something called a disclosure schedule, right? Where you are disclosing certain facts. I want to stop here before I go to the next section. Any doubts so far? because the next section becomes a consequence of what happens if these are wrong. Okay, then I will go ahead. Sir, anything here? Yeah, I see Grace Healthcare asking me to stop.
Uh, Hi, Sandesh. This is Andrew. So,
Right.
as you were talking about the presentation and what we speak to the investor about, it's just more like a promise about the product and how we sell it. So, do we have to necessarily present something like a proof to the investor for whatever we present? How does it work?
Okay.
What is the question exactly? Can you please rephrase that a little bit?
Yeah. So when we present with the investor about the values what we bring on table to a product in terms of revenue and what we give as a promise. So do we have to really substantiate that with any kind of document, or uh, is there a verbal conversation would be fine for that?
That is not really a legal issue, right? It is more about how you convince an investor about your business, right? And in common with all investors, all ventures, what people here are looking for is ability to scale in the most efficient way, right? So that is what any investor looks for. And if it's, especially if it's a financial investor, right? Pure play financial investor. So your question, I suppose, is more related to what do you put into that pitch deck and your presentation. From our side as lawyers, we can probably safely tell you, please avoid saying anything legal, right? So only a word of caution, jokes apart, is if you have any product over which there is a possibility of getting a patent, then please don't discuss it with anyone, including an investor, unless you've taken steps to protect that IP. Okay.
Okay. All right. Thank you.
Sure.
So we have the last half an hour left. I'm just going to see how we can segment the presentation in a different way. So just bear with me for a second.
Sandesh, are we taking up the SHA now?
Sir, so we'll finish indemnity, and
Ah.
then after that, I will put up a main slide with all the broad SHA rights and run through them one by one. And depending on the time, we'll run through the crucial items.
Sure. Okay.
Right. So now, so far you would have made certain promises, and the investor has agreed to rely on your promise, and he would have invested money into the company, right? In case any of those are wrong, or in case, let's say you say, I have paid all my taxes on time and I have no tax dues from the income tax department or from the GST or anybody. But tomorrow, let's say you get a notice for about 20 lakhs in the company, right? And you have to pay a fine to the income tax department, for example. The understanding is that the investor, by investing in your company and you paying that fine to the income tax department, is a loss for the investor also, right? So the investor will say that, please indemnify me, please make my loss good for the promise that you have made which has turned false, right? So this is one example. What happens then is that the investor will say, if anything that you say, I'm relying on everything that you're saying, I'm taking them as true and correct, and I'm investing the money. If anything is not true, if anything is not correct, and if I have incurred a loss because of that, you have to indemnify me for that. You have to make good my loss for that investment. The sometimes what happens is that investors do not have any exemptions on the personal assets of the promoters, right? They'll say that if there is any loss, if the company does not have money, the promoters or the founders might have to sell their personal assets to make me good. So when you are negotiating from your side, you will say that, look, you cannot attach my personal assets for any reason whatsoever, unless, let's say, it's something as egregious or as criminal as fraud or gross negligence or willful misconduct. For small non-compliances, please don't come to me for claiming indemnities. The second is you have something called a de minimis, right? This floor below which the indemnity won't trigger. Say that there are lots of fines in India, right? There are fines for 10 rupees also, there are fines for 100, there are fines for 1,000, there are fines for lakhs of rupees also. So what you'll say is that don't come to me for an indemnity claim for every small amount, for every negligible loss. If the loss incurred to you is above a certain threshold, it's usually about 1 to 2% of the investment, only then you will have a right to claim an indemnity. Otherwise, please don't come to me. Lastly, you'll say whatever happens, right? Whatever the case may be, you have invested X amount of money. Let's say you've invested 30 lakhs. My liability to make you whole, my liability to cover for your losses is only limited to what you have invested, right? If the company has incurred 100 crore loss, but you have invested only 30 lakhs, then my maximum liability towards you, or my maximum responsibility to cover for your loss, is only 30 lakhs and nothing more than that. So these three typically have to be negotiated, or these three things you have to watch out for whenever you receive a document with an indemnity clause against losses. So if this is clear, I will move on, because this can be a tricky concept. All right. So now what happens is, after the share subscription agreement is signed, the moment the money comes into the company, effectively the procedural aspects of share subscription agreement wither away, right? Except for the indemnity obligations, and there are some confidentiality obligations, or you'll have your conditions subsequent. Except for those 2-3 items under the share subscription agreement, rest of the agreement falls away. The rest of the agreement will not have any bearing anymore once the shares have been issued. Then comes your shareholders agreement. So the investor receives shares in the company and he's sitting as a shareholder. So you, as a promoter, you are a shareholder, employee, and a director. But an investor will be a shareholder, and if he wants to be a director, he can be a director, or if he wants to nominate somebody on behalf of him as a director, he's a director. But these two are the only capacities that they can hold in the company, right? At least for the sake of this conversation, let us just understand that an investor can only be a shareholder and a director, and other forms, while we can discuss them, for the purpose of this presentation, it's a little out of scope. Now, how do you go? So when an investor invests money in the company, the share subscription agreement is signed, they get the shares in the company. Now, how are they going to control the company? How are they going to control you as a director and as a shareholder of the company? Because as an employee, you sign an employment agreement, right? So there are certain sets of clauses that they ask for in a typical shareholders agreement, right? So you will have the first set of clauses is information rights. So your investor, whoever is investing, typically is not going to be involved in your day-to-day affairs. They will ask for a monthly call, they'll ask for your bank statements, they'll ask for important contracts. If you're entering into a contract of, let's say, 500 crores or something like that, then they might want to ask you for a copy of that contract. They'll also ask you for your audited financial statements. They will also ask you for the right to come into your company's premises, to go to your CA's office and check your books of accounts, to check your filings. Whether they do that or not is something that nobody knows, but they would want to have that right to come and check, right? Sometimes, if the round is really big, if the company is really big, and if they have to engage certain professionals to do the audit on behalf of them, they will say that the company has to pay the money involved for our inspection. So as founders, it is best to say that I will pay only for once, or I will pay only for 2 times, or I will pay only up to 1 lakh or 2 lakhs, or whatever the amount is. So you can either negotiate a cap or a number of times that they can inspect, depending on the negotiation, depending on how the conversation goes, this is something that you can look at. The second set of rights are your control rights. So one is you get information, you have to give them information on time, and two is the set of control rights, right? So there are two sets of rights even under control rights. One is representation wise, so that is how are they being represented and how are they being perceived in the company, and two is what happens to shares, their shares and shares of everybody else. So board representation and representation at shareholder meetings, simply put, they're going to say that any board meeting is held, you have to give me notice, and any board meeting that is held, if I am not there, then you cannot hold that meeting. Or rather, they also ask for veto rights, right? They ask for reserved matters where they say that, look, you can hold your board meetings at any point in time. You just give me the notice. Even if I don't attend it, it's fine. You hold the board meeting. But if you're deciding on certain crucial items, for example, let's say if you're changing your business plan, or you are trying to bring a new investor into the company, or if you want to appoint a new director in the company, or if you're taking a loan beyond an X amount into the company, or even if you're starting a new line of business, for example, there will be about 15-20 items that they will say that these are veto items, right? These cannot be discussed or these cannot be approved without my consent specifically, right? Also same holds for shareholder meetings as well, right? Under the Companies Act, some of the items can be decided by the board and they can move forward, but some of the items have to be decided by the board and also have to be decided at shareholders meeting. Classic example of this is fundraising, right? Anytime you want to issue new shares to any new investor, the existing shareholders have to approve the terms of those shares. So what happens is you give a notice and you say that these are the number of shares being issued, these are the rights, this is the amount, this is the instrument, please approve. Your shareholders meeting is conducted, they approve these terms, and only then the process moves forward. They will also say that, look, you cannot hold a shareholders meeting without me being present, right? Those conditions also will be there. So these two are representation rights. The rest of them are on rights relating to shares. With respect to shares, there are two ways of giving shares to someone. I use the word giving because a person can acquire shares either through fresh issuance, that is, the company generates new shares and issues those shares, or you guys or any of the existing shareholders can transfer their shares to somebody else, to them. In case of a preemptive right, in case of further issue of preemptive right, this is triggered when the company is issuing new shares. So what happens is, let's say the company currently has 100 shares and two people, right? So there's 50 shares for one person, 50 shares for other person, and both of them hold 50-50, right? And you are issuing new shares, you're issuing 50 new shares, right? And totally the capital base of the company from 100 becomes 150 shares. Then the person who was holding 50 shares but was holding 50% now suddenly becomes a one-third holder, suddenly holds 33%. So their percentage stake in the company falls down. So then what happens is, for them to be able to hold the same amount, that is the same 50%, they need to subscribe to 25 shares more. So this is a preemptive right. That is, you are effectively subscribing to more shares in any new issue of shares to maintain your shareholding percentage. This is the first set of rights in a shares issuance. The second is transfer restrictions. So I, as an investor, would have invested in the company knowing that you guys as promoters are the most capable ones. You are well suited to run the company. You have the relevant expertise in the industry that you're operating in. Hence, I'm making the investment in the company. Because typically at these stages, the investment is more on the confidence of the founders rather than the performance of the company itself. So the incentive for the founders to stay in the company is money, right? Only when the value of their shares increase, where can the company also grow and the investors also make money. So they are going to say that, look, the promoters cannot sell their shares for first 4 years, or the promoters cannot sell their shares for uh, 4 years after we invest, however old your company may be. In case the promoters or any other shareholder is selling their shares, they have to first come to me. And only if I buy those shares, only if I say no, they can go to somebody else, right? So this is divided into two concepts: the right of first refusal and right of first offer. The simple difference is right of first offer is I come to you first to sell my shares. Whereas in a case of right of first refusal, I go out to the market, I find somebody who's willing to pay X price, let's say 100 rupees per share to me. I come back to you and say, look, there are three people outside willing to pay 100 rupees for my shares. Can you buy my shares at 100 rupees? If it's a yes, you have to sell your shares to me at 100 rupees. So effectively, the right of first refusal is that the onus of price discovery lies on the seller. That's the person selling the shares. But in a right of first offer, the onus of price discovery lies on the buyer, the person buying the shares. Typically, investors ask for a right of first refusal because they don't want to take the onus of doing price discovery. Rather, the person selling the shares should go and tell them what is the price at which they're able to sell the shares in the market. The next set is tag along rights. So what happens is if your company is performing really well, and if there is a very large company or if there's a very large investor who wants to acquire a controlling stake in the company, and the founders sell their shares, investors will say that, look, if you are selling your shares, then I also am going to tag along. Effectively, I'm going to give you. So if the new investor wants to buy 51% of the company, and you guys hold as founders, you guys hold I don't know 30%, 20%, 30% of the company, then the investor will say, to the extent that you are selling your shares, I also want to sell my shares. Or rather, sometimes an extreme clause will say that if there is anything, if you're selling more than X percentage of your shares, I will get to sell all of my shares. The reason is if you don't have enough stake in the company, if you don't have enough skin in the game, the investors don't want to stay in the company. So that is effectively the purpose of what a tag along right is. The next is exit rights. This is more relevant in the context of venture capital funds, because venture capital funds also, they don't invest their own money. They take money from other people. So high net worth individuals, university endowment funds, insurance and pension funds, and so on, where there are large pools of capital for people to invest. Now, under the conditions between the fund and their investors, they're supposed to return the money back to them in 10 years or 8 years or 12 years, depending on the terms between them. So what the fund will come and tell you is that I need to return my capital back to my investors in 8 years. So in 7 years, you have to give me an exit, or in 5 years, you have to give me an exit. And what are these exit? So you can either go to an IPO, that is sell your shares in the public, or you can find a third party buyer for them to buy the shares, or you can find a strategic buyer, somebody in your industry who wants to merge with you or who wants to acquire you, or you as promoters buy it back personally with your own money. And there will be other ways. These are typically the 4-5 ways in which the exit rights are asked for. Then there is your liquidation preference. Liquidation preference is in case the company winds up, in case the company is shutting down and is getting liquidated, the meaning of which is it's everything is getting closed and you're getting the money from selling off your assets, selling off your IP, etc. The investors get paid first. So let's say if they've invested 30 lakhs, they need to get their 30 lakhs back first, and only then rest of them can get their share of money. And the last bit is anti-dilution. So today, let's say you're raising money at valuation of 10 crores. 2 years later, for whatever reason, you're not able to raise money at 10 crores or more. Let's say you're raising money at 8 crore valuation. Now, the value of the investors holding at 10 crores and 8 crores has already fallen, right? So you have to either give the investor new shares to maintain their shareholding and the value in the company, or because it's a CCPS, it is compulsorily convertible preference share, your conversion ratio, that is, when you start off in the company, you say, okay, for every one CCPS, I will give you one equity share. Because the value of that CCPS has now fallen, because the valuation of the company has fallen, you will give them additional equity shares upon conversion for them to maintain their shareholding at a value of 10 crores. So this is the broad concept. We have 10 minutes. So I'm going to stop here and take questions on any of these rights that I've discussed so far.
Yeah, I think the topic by itself is such that there is always the possibility of information overload. So if the people here would like a short follow-up session sometime, you can request the very helpful organizers who have put together this session, and we'll be happy to meet you again. But in the meantime, yeah, any questions, and we'll take them.
Hi, good morning. This is Charles. We are part of a mental health startup. So thanks for the presentation and detailed overview on all the term sheet and shareholder agreement. So you mentioned about investor rights here. So are there any rights that you find used very often, and are there any rights which are used very rarely? So are the rights which are used very rarely, which tells the rights more in favor of the investor? Are there any specific things that you have observed in your experience?
So all the rights that we presented are standard rights, which you will find in any standard shareholders agreement. Okay, so on paper, all of them are pretty standard. In terms of practical exercise of these rights, investors, while they put in their money into your venture, expecting a financial return, right? That is the end game. They want to exit at a good upside, with a good upside. They also understand that the vast majority of businesses fail, which is why they will not enforce the exit rights in an extremely harsh manner, right? As long as the promoters are being honest, the business is being honest. Otherwise, the day-to-day operational control that is given to them by some of these rights are in fact exercised. So they will ask for a board seat. They may ask for, some investors are risk averse. They don't want to have one of their people sitting on a board. So they may ask for something called an observer right, where their representative is in the room but not on the board, right? So this level of oversight which these rights, some of these rights give to the investor, they are routinely exercised. They do ask for information. In fact, many of them ask for too much information, and we have come across situations where promoters do crib that instead of running the business, they're spending their time giving information to the investor. So in all these cases, the bottom line, however much these copious documents are written, is a very strong factor of trust between the investor and the promoters. Right? If the investor trusts the promoters and they know that these guys are really sincere and they're doing what they're supposed to do, then they will not be the nagging investor type, right? They will allow you to get on with what you do best. At the same time, add value in terms of guidance. Just to take one step back, when Sandesh was referring to the some of the rights that are attached to the shares, you must understand that shares are a kind of property. Okay, so any property related rights that the shares carry will be exercised. To answer your question, so the rights that are related to supervision and oversight will be exercised. The rights that are related to the shares as property, which means transfer, etc., those will be exercised. But anti-dilution will certainly be exercised if there is a down round. When we say down round, a further fundraise which is happening at a valuation lesser than what I as an investor entered the company at. That is a down round. The exit rights will not be exercised unless there is a serious issue with the promoters, the company, and the investors. So, Sandesh, pitch in if I'm missing something.
No, sir. I think you covered everything. So one of the core rights in terms of oversight that they exercise is your reserved matters, veto matters. So whether they have an observer or not, whether they ask for information or not, one of the things that's common across all investors is they would want to exercise veto powers, because veto is designed in a way that can affect the value of their investment directly, right? So that is one thing that we've seen. Sir, there are other questions in the chat. So Dhanashri Krishnamurthy has asked that there are currently two members and they're in prototyping stage. So should they incorporate a company or an LLP, and which is better?
See, honestly, I think this is a conversation that you should have with your business mentors, because we really don't know where you are in your journey as a prospective venture, right? From our experience, all we can tell you is don't rush headlong into forming a private limited company, because the thing with a company is your compliance requirements will start from day one, which means both not much time. You don't have to spend time in complying, but you need to engage professionals who will help you do that, and you will have to allocate some budget towards making sure that these things happen on time. If you think that you're not yet ready to take the plunge, right, because of some uncertainty, it could be an uncertainty related to product development, it could be uncertainty related to your founding team, then pause and wait for the right time, and probably your business mentors will guide you as you approach that milestone. And once you hit that milestone, we always recommend a private limited company and not a LLP, simply because even today, if your business is something that you want to scale up and you need external funding, the private limited company is the vehicle of choice, right? I don't know
Thank you,
whether
sir.
you have
That
answered it. Yeah.
actually you have cleared the doubt. Actually,
Okay, thank you. Then as an exit early stage startup, how do you plan legal framework? Well, this is more of not so much core legal framework. There, it's a mix of legal and operational matters that you have asked here, right? Honestly, we would need to have a one-on-one conversation with you to understand more about your business and the team, and see if we can add value to the question you asked, sir.
Thank you.
Okay, constitution of the company would anyway come by default, right? At the time you have incorporated, you will have a standard memorandum, you will have a standard set of articles. Beyond that, right, when you start on your journey, do you need to do anything more? That we will probably be able to tell you once we get to know the business better.
So just one thing to add, in terms of planning legal framework per se, like sir was saying, building a good relationship with a chartered accountant just helps, right? So before taking any serious corporate action, just picking up the phone and asking your chartered accountant, even if it's a slightly legal question, things like, okay, I'm firing this employee, is there anything I need to look at? I'm starting a new line of business, is there anything to look at? I am planning this fundraise, is there anything to look at? So any major corporate actions that you're planning to do, if you can just have a CA or a CS guide you in a proper fashion, I think the legal framework will sort itself out, because most of the legal items or compliance items are always incidental to the operations of the company itself, except for a handful of standalone compliances, which anyway you will be doing by yourself. I hope that answers the question in a more concrete way.
See, we come back again and again to the fundamental concept that a company is a separate person from the founders. Okay? From a business perspective, from a personal perspective, it is very natural for the founders to think of their company as just an extension of themselves. But legally, that would be a mistake. From an accounting standpoint, that would be a mistake. So we come across hundreds of cases where promoters put cash in and take cash out as and when they please, as and when they think that it is necessary to do that for the business. But that is where you will need the help of a CA to keep you kind of focused on the idea that your company is different from you. As long as you keep that in focus, then you will do the right thing. LLP can be transferred as a private limited company. There is a process, I think, but please keep in touch and we will tell you the details. Okay.
Yeah, there is a conversion process. It's a slightly tedious process actually, where you need approvals from the ROC. You need to hold a couple of meetings, sign a couple of handful of
It
undertakings.
might be better to close down the LLP and start a company afresh.
Yeah, yeah, it is. It is. So we
Depends on
see
the
this
cost.
adoption.
Depends on the cost and how far have you traveled along the journey as an LLP.
We see this more in the real estate sector than anything else, where LLPs are converted to companies. But for any other sectors, we would ideally suggest just going with the private limited company. Take your time to get ready, but just start a private limited company. So need a little more insight on CCPL. Any clause on how CCPL would work? Major stake, exit plan between investor, startup. Okay. So do you want to take this question?
Yeah, I'm just going through that. See, when you say CCPL, I suppose you mean CCPS, right? Compulsorily convertible preference shares. Now that is the vehicle which that is the instrument which most investors will prefer. Okay, and it works in a very simple way, right? There are two situations. One, in the early stage of the venture, you don't know what is the value of the venture because you could be pre-revenue or very early stage revenue. So you really don't know what is the commercial worth of the venture. And therefore, you do not know what is the value of every single share because a share is just a share of your company. Right? It is just a fractional part of the whole business. So in such situations, what your early stage investors will do is they will tell you that today on day one, I am putting in money, trusting you, mainly the promoters, right? And your story. Now, on day 400 is when you will probably find your next investor. But because I came in so early and put my faith in you, I will convert into equity shares at a certain discount to what your next investor is coming in. So there is a certain sliding scale and some, I would say, well-oiled principles by which this is arranged. But conceptually, this is what will typically happen in an early stage venture whose valuation is difficult to determine, right? On the other hand, after you have raised a couple of rounds and you know what is the worth of the business, then it becomes easier for everybody to talk about valuation in a way that is transparent and mutually understandable because they know the numbers and the professionals can help you identify what exactly is this worth. So you will be able to accordingly structure your pitch to the investor. Specific exit plan under CCPS, what Sandesh was talking about, there is usually a 4 or 5 methods by which the investors say that they have the right to seek exit. How much of that is practical is a separate question. For example, IPO is the number one item, but most 99% of the companies don't even reach the IPO stage, right? Then there is a sale of the assets. Then there is a buyback by the company. Then they may say they will find a buyer and then sell out. So these are the typical exit methods that an investor will ask for, but nothing special as far as CCPS is concerned. Is CCPS recommended for startup promoters? You really don't have a choice because your investors are going to ask for CCPS. One advantage that you will also have is it will give you time to really run the business and assess the value before your investors convert them to equity. Otherwise, on day one, if you give them equity shares, then you end up diluting straight away, right? So this gives time to both parties to assess the valuation metrics. 1 second, sorry. I think I may have missed The question, yeah, CCPS is done. Director can have a loan agreement with any number of get funds from them, bring it into company account as director investment. Yeah, but our advice is it may result in a mess. So this is where probably a good chartered accountant with experience can help you and tell you what is legally okay, what is optically good. Right? How can we get in touch with you? Email. Yes, we will share our contact details. Okay, that is already done. Does dilution always have to trigger liquidation preference clause? No, liquidation preference is when the company is being wound up, pretty much. It's being liquidated. Whereas dilution can happen while the company is a going concern. It is just that compared to the earlier round one, round two is happening at a value that is lesser than round one. And therefore, the investor who came in round one is suffering a reduction in the value of their investment.
Hi, Karthik. I have a follow-up question on this. So currently, we are raising a different round, and this is not in context to the previous investor. So when we are negotiating on SHA and SSA with them, there's a line mentioned over there under LP that it will get triggered in this scenario that a series of events might affect or might trigger LP, and like dilution might also trigger LP. So we know that this is in case of a going concern, but then how to push back on this with investors, lawyers?
I'm not sure whether, I don't know, Sandesh, whether you understood the full import of what Mansha is asking. See, it is possible that the investors are saying that if you are going through successive down rounds, we will treat that as a liquidity event.
No, we are not going through down
No,
rounds.
I'm
We are
saying
actually
I'm saying that the documentation may say that. Please explain.
okay. So anyway, the valuation of the company is increasing, so it's not a
Okay.
down round for us. But
Okay.
then they are saying that LP will get triggered if there is like dilution, and then we are in constant talks with them that anyway, like if we are raising multiple rounds from now on, there will be dilution. But then
Right.
they are constantly asking us to reinstate this, that no, this will trigger the LP. So I wanted some clarity on this.
No, if the value of the company is increasing,
Yeah.
the dilution that they will suffer is more than offset by an increase in value, right?
Yes.
That is the pushback, if you ask me.
Okay.
For the same number of shares, your absolute number 100 shares is remaining 100 shares.
Yes.
Earlier you held 10%, because of the next round you are coming down to 8%, but your 8% is much more worth than your 10%.
Yes.
So that is the pushback, if you ask me.
Okay. Maybe I think that is the
Yeah, you're continuing to sit in the bus and have this nice ride, right? And you're getting an upside. So
yeah.
dilution is a given. Promoters are also diluting. Everybody is diluting, but you're diluting, and the offset is that the value per share, your investment value is going up.
Okay.
So it shouldn't trigger liquidation preference for that. I mean, I don't know.
Ideally it shouldn't, but then
At least it doesn't make any sense to me. So, sorry.
Just to add to Sir's answer, Mansha, the liquidation preference gets triggered upon a liquidation event. So please look at the definition of liquidation event. So it'll say a liquidation event means dissolution or winding up or substantial sale of assets of the company, or all of these things, right? A liquidation preference is never linked to a future fundraise. It's always linked to a business failure.
It's a negative event.
It's a negative event. So if they are talking about liquidation preference in the context of a fundraise, then conceptually they're either asking for I don't know, they want free shares to maintain their shareholding irrespective of increase in value, or they have got the concept misunderstood. So these two are the only possibilities that we see.
No, that's where the preemptive right comes from. Comes
Yes.
in, right? Existing investors have a preemptive right in order to maintain their percentage holding. And that doesn't come mufat, right? They have to put in money and get issued more shares so that it's like topping up. Whereas
So,
liquidity,
yeah, and that is what my concern was, as Sandesh you correctly mentioned, that dilution shouldn't come under liquidation event. But that is how they have defined in the agreement that, this comes under liquidation. And anyway, we have to, being an early stage startup, we have to dilute the firm, like the shareholding to raise funds. I think this was my doubt. So we maybe negotiate with them on the valuation aspect
Yes,
of it, that,
yes.
you are getting a higher value even for a lesser ownership.
yes,
Yeah, thank you.
absolutely. Unless they're worried that some rights that they have been given have fallen away because they have come below a certain threshold. I don't know what the details are. Suppose your earlier agreement with them said that you can be a director on our board if you hold 10%, and because of this next round they are coming below 10%, they may be worried. That's possible. Old investors don't
Understood.
believe in the new increased valuation, Dimitri. No, that can't happen, sir. The question from InUAid, old investors don't believe in the new increased valuation. That is a point of discussion and agreement, right? And always the old investors would want the valuation hyped up, in fact, right? Because it will give them that much of more of an upside. If they're being conservative and say, no, I don't think that your venture is now worth this much, either they're being conservative or I don't know, but fundamentally, it's not a question of believing in any new valuation. These are things that are quantifiable and demonstrable by numbers, right? So, if there is a difference of opinion between professionals, that I understand. Their internal team may say, no, we don't go by these numbers. Then it's a matter of discussion, debate, and finally convincing them of a certain valuation. But I don't see why they would complain if the valuation is going up. Unless they're pushing you to actually increase the valuation. You are coming up with a more conservative valuation and they're saying, no, you're actually worth much more.
Okay, so I'm just posting our email IDs in the chat. If any of you have any questions from here on, we're happy to take it offline. I've put Karthik sir's email ID and mine as well. So thank you all for the session, and thank you IIT Madras for the opportunity to address the team today. So look forward to speaking to some of you soon. Thank you.
Thank you very much and good day.
Thank you, Karthik and Sandesh. Thank you. It was nice.
Thank you so
Yeah,
much.
thank you, Sandesh and Karthik.
Thank you.
Sandesh.
Thank you,
Thank you,
everyone.
Karthik.